If you own a rental property or you're thinking about buying one, the rules you grew up hearing about just changed. After Budget Night 2026, an established rental property that runs at a $15,000 annual loss will no longer let you cut your salary tax. That benefit ends from 1 July 2027. But here is the loop I want to close today. Some properties are completely safe, some claims still work perfectly, and there is one type of purchase that keeps the full benefit. Let us walk through exactly what you can and cannot claim, step by step. Let me show you why getting this wrong is expensive. Under the old rules, a $15,000 rental loss reduced your tax by about $5,850 a year at a 39% effective marginal rate, according to the 2026 budget fact sheet. That was an immediate cashback refund. Under the new quarantining regime for established properties bought after Budget Night, that same $15,000 loss gives you zero immediate refund. Over 10 years, that is roughly $58,500 in foregone refunds for a 39% taxpayer. Buy the wrong property and you do not just lose a deduction. You turn a guaranteed annual benefit into an uncertain future one. So the order of these steps matters. Step 1. Confirm which of your properties are grandfathered. This is the most important thing you will do because grandfathered properties keep the old rules entirely. The cutoff is 7:30 p.m. Australian Eastern Standard Time on the 12th of May 2026, according to the budget papers and the ATO. Anything held or under contract before that exact moment is fully exempt. To check, log into MyGov, select the ATO link, and open your income tax returns from 2022 through 2026. View the rental property schedule and note the acquisition dates, then cross-check against your settlement statement for the true contract date. If your contract date is before that cutoff, you can keep claiming losses against your wages forever. Here is what grandfathering is worth in real numbers. Take an investor with an established unit bought in 2022 running a $12,000 annual loss. She can still claim that against her $140,000 salary, dropping her taxable income to $128,000 and saving roughly $4,680 a year. That is 39% of $12,000 per the budget fact sheet. Over 10 years, that is about $46,800 in cumulative tax savings. A new investor buying the identical property after Budget Night gets the same loss, but zero immediate refund. Same property, completely different outcome. It all comes down to the contract date. Step 2. Understand exactly what quarantining means because the word gets thrown around loosely. From the 1st of July 2027, if you buy an established residential property after Budget Night, the losses do not disappear. They get fenced off. They can only be deducted against other residential rental income or capital gains from residential property, according to the ATO and budget fact sheet. They cannot touch your salary, your business income, or your other investments. If you do not have enough residential income to absorb them, they simply carry forward to a future year. So the loss still exists on paper. It just stops being a current year cash refund and becomes a long-term deferral instead. Step 3. Model your actual future tax position. Do not guess this. Use the ATO individual tax calculator on the ATO online tools. First, work out your expected annual rental loss, that is rent minus interest, rates, insurance, and repairs. Then run 2 scenarios. Scenario A includes that loss against your wages, which is what happens for grandfathered properties and new builds. Scenario B excludes the loss from your wage income, which reflects a quarantined, post-budget, established property. The difference in tax payable between A and B is the annual refund you would lose by buying established under the new rules. For a typical investor, that gap is several $1,000s a year, and if it shows zero for an established purchase, you have modelled it correctly. Here is why Step 3 matters so much. Say you are weighing an $800,000 purchase, running an $18,000 annual loss. If it is a new build, you can still deduct that full $18,000 against your salary, saving about $7,020 a year, 39% of $18,000 per the budget fact sheet. Over 10 years, that is $70,200 in real-time refunds. Buy the exact same property as an established dwelling after budget night, and that figure is zero. $70,000 of difference based purely on whether the home is new or established. That is the single biggest decision in this whole episode. Step 4. If you still want that annual cash flow benefit on a new purchase, look at new builds. According to the budget papers, new residential builds bought after budget night remain eligible for full negative gearing against your other income. That means an $18,000 loss on a new build still drops your taxable income and delivers that roughly $7,000 annual refund. It is the only post-budget purchase path that keeps the immediate benefit alive. Just be careful to confirm the property genuinely qualifies as a new build under the rules before you rely on it. Get that confirmed in writing from your accountant, because the established versus new line is where the whole benefit lives or dies. Step 5. Plan your eventual sale, because there is a second change that interacts with all of this. From the 1st of July 2027, the 50% CGT discount is being replaced for individuals, trusts and partnerships with cost-based indexation and a 30% minimum tax rate on net capital gains, according to the budget papers. The reforms only apply to growth that accrues after that date, so pre-2027 gains keep the old treatment. Your quarantined losses can be used to reduce a future capital gain, but that gain is now taxed under the 30% minimum rather than being half-taxed. Use the ATO CGT calculators to model both the old and new rules for each property before you decide when to sell. Let me put a number on the CGT side. Under the old system, a $300,000 gain got the 50% discount, so only $150,000 was assessable, and at a 39% rate, the tax was $58,500 per the budget papers. Under the new 30% minimum tax on the full gain, that same $300,000 gain attracts $90,000 in tax. An extra $31,500 on the identical nominal gain. Your carried forward losses can soften this by reducing the gain first, but the effective rate on what is left is still higher than the old discount. Less benefit up front, more tax at the end. That is the combined squeeze. Step 6. Document everything and get proper advice before you act. Keep your contract dates, your settlement statements, and your title records, because that single cut-off moment decides which regime your property falls under. Track your carried forward losses carefully each year, since they are the asset you will eventually use against a future gain. And before any purchase after the 12th of May 2026 cutoff, sit down with a registered tax agent and confirm whether the property is grandfathered, established, or a qualifying new build. The rules are clear once you know them, but the dollar difference between getting it right and wrong runs into tens of thousands. Here is the whole thing in one number. Take an investor who buys a second established property after budget night and holds it 20 years. She loses roughly $140,400 in expected annual refunds over that time based on the budget analysis. She does claw back about $55,500 in lower CGT by applying her quarantined losses against the eventual gain. But net it out, and she is still around $84,900 worse off over 20 years compared with a world where she could fully negatively gear and keep the 50% discount. The lost annual cash flow simply outweighs the CGT saving. Before we recap, the two mistakes that cost people the most. First, assuming that any negatively geared property still cuts your salary tax. After the 1st of July 2027, an established property bought post-budget gives you zero immediate refund. Investors who budget for a $7,000 annual refund that never arrives can end up with serious cash flow problems. Second, confusing the settlement date with the contract date. Grandfathering is decided by the contract date, 7:30 p.m. on the 12th of May 2026. If you sign before that but settled after, you're still grandfathered. Get those two things right and you avoid the most expensive errors in this entire reform. Let us run it back fast. Step 1. Confirm which of your properties are grandfathered using MyGov and your contract dates. Step 2. Understand that losses on new established purchases are quarantined to residential income and capital gains only. Step 3. Model 2 scenarios in the ATO tax calculator to see the refund you would lose. Step 4, consider a new build if you want to keep full negative gearing against salary. Step 5, map your exit against the new 30% minimum CGT rules. And Step 6, document every contract date and confirm the plan with a registered tax agent before you buy. If this helped you see what you can still claim, do one thing today, then go find the contract date on every investment property you own, because that single date decides everything. Subscribe to the fine print for plain English Australian tax and money explainers that actually help you keep more of what you earn. And watch our next video, where we break down whether a new build investment property is actually worth it once you factor in the new CGT rules. Remember, this is general information only, not financial advice. See a registered tax agent for your situation.